Hi everyone, thank you so much for joining us. My name is Fawad Razaqzada, market analyst with Think Markets. Today in the room we also have my colleague Victor, who will also be uh, analyzing the markets with me. So for those of you who are new to this webinar, the live market analysis happens every Tuesday at 11:30 London time. And this is mostly like a technically focused webinar, although we do mention fundamentals as well. And it's meant to be very interactive. We talk about the markets that you guys are more interested in, rather than providing analysis on the markets that we want to talk about. So please feel free to ask us questions in the questions box, okay? Before we begin, please have a read through the disclaimer, and then we will share some live charts. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So in terms of the agenda for today's webinar, I discussed, we talk about technical levels on major currency pairs, gold indices. We touch on fundamentals. Most of the time, though, is based on technical analysis. There are F and then scenarios on on major currencies and indices. So if one level breaks, then this is potentially going to happen next, etc., etc. Also, we'll have a Q&A session, but don't wait until the end of the webinar. Okay, so ask your questions as we speak. Right, let's close this, and I'm gonna share the charts with you. So what you're seeing here is the Nasdaq futures, okay, or the CFDs on Nasdaq futures, and you can see that the Nasdaq is down for the second day. Other European major global indices are higher. So hold on, let me get. Yeah, this is the DAX. The FTSE is higher, and this is the Dow indices. The Dow index. Yeah, go on, Victor. Did you say something?
The great rotation is happening
exactly
from technology shares into value-oriented stocks, and basically stocks that have been considered as junk up until a day ago.
Yeah.
So
that's
you wanna be careful with if you're used to be buying the Nasdaq when good news come in, you might be in for a nasty surprise.
Yeah, absolutely. So that's the reason I'm sharing the Nasdaq with you guys here, as Victor mentioned. So this is the second day that the spread between momentum and value has widened significantly. Investors
maybe we can explain what's momentum and value for those of our listeners who don't know.
Yeah, go on then. Do you want to take a shot at it?
So sure. So momentum stocks are generally considered by investors as growth stocks, meaning that the companies might not be making that a significant amount of money at the moment. However, they are positioned to grow their businesses materially. Usually such stocks are heavily technology focused. And this is what we're seeing over the past couple of days, that these names that we all have been um, observing, taking this market to new all-time highs over the past 6 to 8 months, are now becoming way too unpopular, just because the prospect of the economy returning to normalcy, with the physical world taking a bit of digital shine, if you want to put
Yeah.
it this way. There is a renewed interest in so-called value stocks, which have been considered basically useless over the past 6 to 8 months. So
Yeah, not I wouldn't say completely useless though. I mean,
yeah,
there have
not
been some
completely.
stocks in
However,
the sector. Yeah.
however, if you look at levels, for example, of major oil companies, which
Oh yeah,
have
yeah.
been trading at levels seen at the end of the 90s,
Mm,
we are quick to observe huge turnaround.
yeah.
And as a result, we also see a shift away from US stocks into European stocks,
Absolutely.
something
So
that has been also totally unpopular over the past several months.
yeah,
And while the US indices kept making new highs, especially the NASDAQ,
yeah.
the the European indices have been trailing behind, and we're seeing this trend change
Yeah.
over
So
the
I
past
think
two
one
days.
of the reasons for this, obviously the vaccine news, Pfizer's announcement yesterday that they made progress on the COVID vaccine, that has changed everything completely. With regards to Europe outperforming the US, I think it's because people are now thinking that if the world economy does recover and people start to things start to turn back to normal, where is the value? And because the European markets have been underperforming, as they are more impacted by the real economy, right? Um, it's likely that we will see a stronger performance in this side of the Atlantic than over the States, where the stocks had already risen to crazy levels. And the fact that there's been some progress made on COVID vaccine, this has raised a speculation that perhaps central banks and governments will now wind down stimulus. And we all know that the US markets have, the main reason US markets have risen to those levels is because of a stimulus.
They have benefited from all these money printing all over
Exactly.
the world, really.
All over the world, indeed, but mostly I would say American stocks. So we may see European indices outperform US for the next couple of weeks, months even.
Yeah, I wanted to also jump in here and
Yeah,
mention that the results from the US election
yeah,
also have a hand here, because the likelihood of escalating trade tensions between Europe and the US has now diminished dramatically
yeah,
under a prospective Joe Biden administration.
yeah. And also China, as well as you mentioned, Joe Biden, he is going to have he's going to be more friendly towards China, right? So watch out for
I
Chinese
wouldn't
equities.
go that far.
You
I
wouldn't go that
don't
far.
think that
I
I
would say
don't think
friendlier
that
than
there will be much difference in the stance towards China, simply because the thesis that American jobs are
yeah,
disappearing into the Chinese economy is very, very popular for the Democrats as well. So now that the subject has been opened, I don't think that it's likely to get closed very, very soon.
Yeah, but I think that the rhetoric is going to change slightly. I don't think Biden will be as outspoken as Trump has been about the issue.
No, sure.
Yeah,
of course, the rhetoric will be more civilized. That's for sure.
Also, China is it relies on world demand, right? So if we return to normal things because of the vaccine, then we could see an accelerated growth in China, which could lead to sharply higher value for the Chinese equity market. So yeah, did you want to add anything else to that before we move on?
Well, if we look at major indices, I would also emphasize the Dow Jones and the fact that it hit 30,000 at one point yesterday. This is a psychological level, and there is a bit. I'm getting nervous on U.S. stocks in general.
Yeah.
Because despite the fact that we have all these, money flowing into the system and into the market, obviously, there is a very the market cap to GDP numbers are insane. We have reached numbers that we have never seen before. By this measure. So the fact that we have a vaccine doesn't help people in the next 3 months, I reckon. And and I still think that that we need some stimulus. In the US, especially if we don't get that, which is at this point, I would say even likely, because the division between Democrats and Republicans seems to be getting wider and not thinner. And the likelihood that Democrats retake the Senate is practically non-existent. At this point in time, so
they're going to provide some resistance, in terms of stimulus and everything else.
Well, they're going to be willing for more stimulus. The Republicans are going to be playing the fiscal conservatives side, and trying to hamper any efforts by the new administration, so that it basically fails. So. We don't see any dialogue, right? At this point in time. I'm skeptical we're going to get there.
The flip side of it is also the Democrats will not be able to raise taxes because they'll face resistance from the.
This is true.
So that effectively is a form of stimulus if you think about it, because taxes will not rise as had been expected they would have under the Democrats. But I think with the Democrats being in government, they will have a mandate to fulfill, right? They will say to the Republicans, look, people voted for us because they liked our mandate more than yours. So for that reason, I think although the Republicans will still offer resistance in terms of accepting a stimulus, a larger stimulus package, I think eventually they will have to kind of allow the package, a bigger package to pass, because of the fact
let's first wait for them to accept the election.
Well,
results.
That's the thing. They haven't they haven't accepted it yet, have they? Anyway, there are a couple of questions from one of our participants. How do you expect the markets to respond to Trump legal actions? For one, I don't think the markets will care too much about that, because he hasn't got any evidence to suggest that there's been fraud in the US elections. So unless there's hard evidence of fraud, then the markets may start to react negatively to Trump's legal actions. So I don't think he has a case there. And how to find suitable shares to trade is another question asked by the same participant. Well, I think if you think in terms of what's happening right now with the vaccine, think about which sectors of the economy are going to start to perform well or expected to perform well. And I think energy shares, travel, hospitality sectors, those sectors are where you need to look into. But after yesterday's big rally, most of those shares have gone up significantly. So it's a little bit risky to buy at these levels without first seeing a pullback to some support level. So I would say create a watch list of all the major stocks you want to be involved in. Obviously, not all of them, but just create a watch list and watch them closely, so that when you do get a pullback to a key support or a moving average or so on, that you could then look for a bullish signal to buy on the back of that. So that's how I would tackle it. But in terms of
what I can add here is that basically you should focus on the most undervalued companies that have suffered the most during this pandemic. The good part investing in these is that they are already very cheap. So even in case you're wrong, you're not going to lose that much if your call is not correct and if they don't rebound.
Just one point on that. Obviously, with trading, leverage is involved. So although Victor says you won't lose that much, obviously you mean in terms of the share price.
In investing in shares.
Yeah. So obviously with trading, it's a completely different game. So just bear that in mind, please, guys.
If you lose leverage, of course, you can always find yourself in the wrong side of the.
Even with a small move. So that's why trading is risky and not suitable for everyone, as we mentioned most of the time. But time is, we spent a great deal of time on the indices. Let's move on to other asset classes. And I'm going to talk about gold here because I think it could be game over for gold. I'll show you the chart of bonds first. Okay, so yesterday, but this is the 10-year yields, US yields. Okay, yields, when yields rise, gold tends to fall because gold is a non-interest bearing commodity. So its appeal rises when yields on bonds fall, but the opposite happened yesterday. So that's one major reason. If yields start to push higher as bond prices fall, that could be one reason why gold could start to go down. The same message, the same thing was evidence in Europe as well. This is the 10-year German bonds, the yield on the 10-year German bonds, and in the UK as well. We saw a big spike higher in yields. So watch yields closely as we transition to the chart of gold. Okay. Now another reason gold is potentially on the verge of a breakdown is the fact that it has again failed to hold the breakout. We presented this part of the gold analysis in the previous webinar. I don't know if you guys were there. It had broken this bearish trend line, and once it broke above that, we saw a significant move up on the night of the election, the day after the US election. And then gold went above the resistance level at 1932. And it looked like it was going to rally significantly from there, possibly get to the 2000 psychological level and possibly a new all-time highs. But this is what happened yesterday as a result of the news of the vaccine. So investors basically closed out their haven bets. Gold fell, Japanese yen fell, Swiss franc fell, all fell really sharply. And so now gold is, bouncing back a little bit from this area of support, but it looks like the damage may have already happened. So don't be
The
surprised.
damage could have been way too big in order for the bulls to retain control here.
Yeah, they lost control completely. This blue level was the last line of defense. If I remove this circle, you see why. This was the last support area prior to the latest breakout. So the rounded retest of that level should have held. It didn't. So now this level is going to be a key resistance if gold were to come back up to this level. Also, this level, this blue level, I think you can see that more clearly on the intraday chart. 1890 is pivotal as well. So that's going to be another resistance level. So basically watch for bearish price action to form within these two red levels now. Okay. And so the picture has completely changed in terms of gold. And I had noted here that this could have been a false breakout scenario, but it looks more like it's a breakdown. It was a breakdown in market structure rather than a false breakout. Let me just get rid of this. This right here. So that was our first lower low. We could see now another lower low below that here. So if I draw another line. Now, what do you want to see next? Yeah, is does gold hold below yesterday's low? So yesterday it formed a big bearish candle, right? So what we need to see next is, does it go down and hold below this level? If it spends some time below this level, then I think that would be really bearish. And after a period of consolidation, I would then expect it to drop and go down to 1800 possibly, and potentially a lot more over time. But the flip side is if there's no acceptance below these lows and price goes back within the existing range, if that happens and we stay in that range for a few days, then that would complicate the picture once again. It would suggest that gold would remain inside a larger consolidation, and we could potentially see the return of the buyers if it starts to break down a few resistance levels, such as the ones I have highlighted on the chart. So right now, it looks more likely that gold will start to fall, given the news of the vaccine and the rise in bond yields and the technical breakdown. But also be prepared for the alternative scenarios to potentially unfold. So it's always good, good to have scenarios. If you're feeling bearish, what do you want to see next? Is price showing you what it should be doing, or is it telling you something else? So yeah, go on.
So if I can jump in here, and if you can switch to the monthly chart.
Yeah, sure.
I wanted to basically emphasize that there is a risk of a very, very sharp down move here. So for those of you who want to try to pick a bottom, this might be a very, very exhaustive process. So I'd advise you against trying to pick a bottom, and just observe a move from 1200 to 2100, obviously, which is like a $900 move that has happened more or less in a straight line if we look at the monthly chart.
Yeah.
And usually the moves down, the unwind of these trades is rather brutal. So
yeah,
have this in mind.
Also, there's a bit of a inside bar failure pattern on the monthly chart. We broke above the inside bar monthly candle. This was the previous month candle. We broke above the high of that, failed to hold there, and now prices have broken below the low of that inside bar candle. So it's kind of taken out liquidity on both sides. And with the monthly RSI being above the overbought levels, kind of underscores what Victor has just talked about. Not to mention the fact that we had the previous all-time high here at 1920-ish, and gold has continued to fail and hold above that level. So all told, it looks bearish, but the long-term trend has been bullish. So what, given what's happened the day before, and these monthly shapes of these monthly candles, as Victor said, you have to be very careful trying to look for a bottom. So perhaps it may be better to wait for price to, if you're bullish on gold, just wait. You don't have to buy it right at the bottom. If and when it does bottom out, you will know, because gold will create a nice looking bullish price candle or a reversal formation. But in terms of where that could happen, well, that's a $1 million question, isn't it? One of the levels is 1800, which was previously resistance. So that could possibly be an area to start looking for bullish setups to emerge around. But even then, it doesn't necessarily mean gold will go to a new record high from there, even if it bottoms out there. It could be that we could see a nice little bounce and then the downtrend continues. But I monitor gold prices closely, so I'll let you know in one of my analysis articles or in these webinars if and when we see gold bottoming out. But right now, it looks quite bearish. Let's move on to FX because we haven't talked about FX yet. And starting with the dollar index, the picture on the dollar index looks quite mixed. On the one hand, you have lower lows and lower highs, price, or the index rather, failing to hold above this bearish trend line, despite it breaking above it previously. Let me just tidy this up a little bit. But, against other currencies, the dollar is looking more and more, well, it depends which currency you're looking at. So against the safe haven Japanese yen, after yesterday's big rally, it has taken the previous high out here. Okay, so what we need to see next from a bullish point of view is, can it hold above this level at 105.35? If it holds above this level for a few days, then that would be bullish, because price will have also broken the bearish trend line. Against the euro, it's looking like it's failed to hold the breakout. So sorry, the euro has failed to hold the breakout. So the dollar's looking a little bit stronger against the euro. We're going to add something here, Victor?
No, I think that the euro dollar and the dollar Japanese yen charts, which you're probably going to get next, into do seem quite exhausted. Both the euro and the Japanese yen seem exhausted at these points in time, and on the weekly chart, we are getting this pattern for a
on the euro dollar, you mean?
If on euro dollar, if we get to 16 again, to 116, this is starting to look very, very bearish. And I don't expect 115 to be even a place where such a move could stop or pause. If we break 116, I think this is going a lot lower. Right.
Okay. Where do you think it's going to go from there if we break 116, Victor?
I would aim initially for 112.15.
112.15.
112.50.
Okay. That's 112.50 is around the between the 50% and the 61.8 Fib retracement. So bang in the middle of the prior range, yeah?
Yeah, basically taking out the prior range high and consolidating, pausing to consolidate somewhere there.
Okay, fair enough. Yeah, so going back to the euro dollar, we had marked this high previously, and when it rallied above it, what we want to see is, can it hold there? It didn't. So right now it looks bearish, but obviously things could change again. Euro dollar is a risk sensitive currency pair. So if stocks continue to push higher, we may see euro find some unexpected support. So in the event it goes back above this black line, at that point it would be bullish in my view. But if it holds below the underside of this bearish channel, then that would be bearish. Yesterday it created a bearish engulfing candle on the daily chart. So things are starting to look a little bit bearish, but it's not completely bearish yet, because as Victor mentioned, it has to break the 116 support area, which is right there. Okay, so right now it's looking potentially bearish, but it's early days. Commodity dollars are looking somewhat more bullish because of the growth story, right? Because of the vaccines, commodity dollars like the Aussie dollar, which has bounced sharply from this key support area at the 70 psychological level. It has broken this bearish trend line and it's making higher highs and higher lows. So going forward, what I would like to see for the Aussie dollar is to hold its own above this blue level here, which was formerly resistance. It held that level a few days ago, and it's now starting to push higher. So obviously yesterday's candle looks a little bit bearish, doesn't it? It looks like an inverted hammer, but it for the bears to come out, I would like to see this level break down, this blue level. So it needs to go below that level, to confirm.
We need
Otherwise,
to break the 72, 40, 50 area, and that's going to open a move lower. So this is what we mean by marking out levels and having scenarios rather than going blindly in at the market selling this, because the alternative is quite possible that we could see rates continue to go higher and take out the previous high at 74-ish, 74.25-ish. So what could trigger the potential rally to that level? Well, if it breaks yesterday's inverted hammer high, then at that point, it would suggest to me that rates will want to go higher. So any move above that level is what I'm waiting for to play out the bullish scenario. So that would be the bullish scenario, bearish scenario below this level. Within this range, is you could trade it short term, but on a daily time frame, I wouldn't pay too much attention to it. Finally, I think it's best we look at a cross, because we want to take the dollar out of the equation, and the euro pound is looking quite bearish because there's optimism growing that the UK economy, well, it's done well. Today we had some improvement on the macro front. Jobless claims unexpectedly fell for the second month in a row, and average weekly earnings improved to 1.3% from 0.1% previously. Also, there's hopes that the Brexit talks are, yielding some progress, and hopefully that there will be a deal soon. I say hopefully because you never know with Brexit talks. So as a result of that, by the way, we had weaker data from Eurozone in terms of the, I think it was the ZEW numbers, right, Victor? That number came out weak and caused the euro dollar to tank. Price is now testing the 200-day moving average, but it's residing inside this bearish channel. So there is a possibility it could bounce back from here, but it will face resistance around this level right here at 89.65-ish. So that level is key. We could see the potential bounce fade around that level and price to then continue lower. The previous low was at 88.66.
If it breaks through that, it will have created its first lower low. Given that price is very close to that level, I think it's going to break that level down. I would be wrong on this bearish view if price were to go and create a higher high above this level. So that would be my invalidation level, if you like, at 90.70. So for as long as we remain below that level, the path of least resistance for the euro pound is to the downside. We have run out of time. If there is anything specific you guys want to ask us in terms of technical analysis or any other thing, please mention it in
There
the
is
chat box.
one question in the panel on how to trade bonds.
All right.
We're currently not offering bonds trading on the Think Markets platform. However,
Yeah.
the best way to trade bonds really is as a proxy is the US dollar.
Yeah.
So basically when bonds go lower, yields go higher, and usually the dollar benefits. That's what happened yesterday.
Yeah.
And that could be only the first day of a larger move. But
yeah, I just checked
nothing
on
is for certain.
Yeah, definitely. This is the Think Trader platform. It's a wonderful trading app, especially the one on the smartphone. So if you don't have it, make sure you download it. This is our proprietary trading platform. I tend to use the what do you call it, trading view charts, because I use different computers and it kind of saves on the cloud and so on. But this is a wonderful trading application as well. Think Trader. Make sure you download it. And as you can see here, we don't offer trading bonds, but you can trade on commodities. We'll get rid of crypto soon because of some compliance in Europe, not allowing retail CFD providers to provide CFDs on cryptocurrencies anymore. So we have commodities, energies, equities. There's lots and lots of equities to trade on. These are the CFDs on equities, by the way. We've got lots of forex pairs, indices, and metals. So you have lots of markets to trade with us. Just wanted to highlight that fact in case you didn't know. But on that point, we're going to end the webinar. And let me thank you for being here for the last, 45 minutes or so. I hope you've all found this useful. Please join us again at the same time next week, 11:30 London time on Tuesday, where I will be providing, possibly with the help of Victor again, our latest views on the markets, both in terms of technical analysis and also macroeconomics as well. So take care. Be careful out there.
Thank you, guys. Take care. Thanks, Fawad.
No worries.
Bye-bye.
Speak to you soon. Bye now.